Hey, thanks everybody. I appreciate y'all taking a few minutes to view this brief presentation on equity expected premiums. And basically, what we mean by that is that there are dimensions of expected returns. And within those dimensions, there are premiums that we strive to target within our portfolios. These are evidence based premiums that have been analyzed and researched over decades and have proven time and time again to outperform. But before we get into the dimensions, let's talk a little bit about market prices. So, in general, of course, we think that market prices contain very relevant information. Prices do reflect the aggregate expectations of market participants. Fairly priced securities can have different expected returns. And efficiently capturing higher expected returns requires a rational use of information contained in security prices. The stock market is just essentially like any other market where buyers and sellers transact to arrive at a price they consider to be fair. Through the competition of the participants, the market acts as a very effective information processing machine. In which knowledge and expectations of the collective investors are quickly incorporated into current prices. So while information incorporated by the market drives stock market prices to fair value, stocks can still have very different expected returns. And in the aggregate, the market will apply a different discount rate to each stock. So using the information contained in stock prices and stock characteristics or company characteristics, we can systematically identify differences in expected returns. But this day and age, the market and information is so fast and readily available to all participants, and it's just very difficult over a short period of time to gain any type of an edge in terms of mispricing or timing, anything like that. It's just very, very difficult. But over long periods of time, there are expected premiums in these dimensions, and we do strive to target those in our portfolios. So let's jump in and look at what those dimensions of expected returns actually are. So first, dimensions point to systematic differences in expected returns. And to be considered a legitimate dimension of expected return, the premium must meet certain parameters, and those are sensible, of course, persistent, pervasive, robust, and cost effective. And basically, we want to make sure they meet these criteria so that we have greater confidence it will continue in the future and is worth pursuing, in an actual real world portfolio. So over here, we actually have these listed out. These are the four premiums that we target and have proven time and time again that they do outperform over long periods of time, and they meet all of the requirements of a legitimate dimension and a premium. So first, we just have the market. So it's the equity premium, stocks versus bonds. I think that's pretty common knowledge, but stocks are expected to outperform bonds. Otherwise we probably wouldn't invest in them. You're taking on added volatility and risk, but over a long period of time, very much are expected to outperform in stocks versus bonds. Company size, so the small cap premium. Small cap companies are, by and large, they outperform large companies over longer periods of time. Relative price, so the value premium. So value or on a relative basis, cheap stocks versus on a relative basis, overpriced or growthier stocks. Value tends to win out in most time frames, particularly over very long time periods. Profitability, so the profitability premium, so high profitability companies versus low profitability companies, they tend to win out over long periods of time. And that might sound like common sense, but there are certainly short-term periods and actually longer-term periods where you might have a junk rally, so to speak, and you'll see those low profitability companies outperforming. But over longer periods of time, that tends to not be the case. So again, these premiums don't always play out the way you would think, and they don't always outperform. So we don't just target these. We tilt and overweight towards these premiums, but we recognize that there are going to be short-term periods and even sometimes longer-term periods where these premiums are not playing out as they have historically over long periods of time. But we have to participate and we have to be positioned to capture these premiums when they present themselves. And that can happen very swiftly without warning. And so you have to be tilted and positioned well to capture these in order to participate over the long term. And that's what we've done in our portfolios. So let's take a look at the next slide here where we actually get into some of the historical premiums and returns on an annualized basis. So we have here along the top the different asset classes that we've chosen to display here. So we have U.S. stocks, international stocks, and emerging market stocks. We have various time frames going back as far as the data would really take us, and depending on the premiums over here that we were trying to target or display, and in the asset class, that would determine how far back we could go with the return numbers. But let's just look at U.S. stocks for an example. We could go back very far, so 1928 to 2015. We have the annualized rate of return on small cap U.S. stocks at 12%, and on large cap U.S. stocks at 9.72%. Two very strong return numbers, but the small cap premium was very much alive and well and outperformed the large cap stocks by 2.28 percentage points per year, on an annualized basis. It's a very large outperformance. And that you can see that's the case. It's the common theme across all these asset classes and all these time frames for each of the premiums. This is a positive number, meaning the premium won out, and in some cases was very dramatic outperformance over each of these time periods. So again, not going to happen over every time period. Certainly there are shorter term periods where this is not the case and the reverse is true. But again, this is based on years and years of academic research and has actually played out in the real world. All this analysis and research points to these premiums really based on strong evidence and research and analysis really playing out over a long period of time. So again, thank you for your time. As always, if you have any questions on any of this, feel free to give me a call, and look forward to speaking with you soon. Thank you.